All right, let's talk about what's going on with the market, because right now it feels like a massive tug of war. You've got this incredible surge of fear on one side, and then you have this complicated, messy economic reality on the other. So which one is actually calling the shots? Let's dig in and figure it out. First, I want you to look at this number, 29.5. Now, what is that? Well, that's the VIX. You probably know it as the market's fear gauge, and it is flashing red. I mean, it recently shot up over 20%, which tells you there is a ton of volatility and just plain old uncertainty baked into the market right now. And that leads to the big question, right? If everyone is supposedly so scared, why isn't the market just tanking? I mean, it's holding on. So there has to be some other force, some counterweight that's keeping everything from dropping. That's exactly what we're going to unpack today.
So here's how we're going to tackle this. First, we'll look at the fear that has its grips on the market. Then, we'll break down what we're calling the 25% fear factor versus the 75% economic reality. After that, we'll pinpoint this week's key data points, the real battlegrounds. And finally, we'll tie it all together to see who's winning this tug of war.
Okay, so let's start with all that fear. A VIX this high, it creates a really unstable situation. Historically, something has to give, and it usually happens fast. Either the fear gauge, the VIX, needs to calm down, and I mean way down, or the market itself has to fall to justify that level of fear. It just can't stay this tense for long. But here is where it gets really interesting. The analysis we're digging into suggests that all this fear we can see and feel, it's only part of the story. Let's call it the 25% factor that's yanking on the rope. And this chart really lays out the whole argument. The idea is that the market is mostly, like 75%, running on the hard facts of the U.S. economy. That other 25%, that's the geopolitical fear. So yeah, the fear is making a lot of noise, but the economy is the 80-ton gorilla in the room. So what's feeding that 25% fear factor? Well, no surprise here. It's mainly conflicts and instability in the Middle East. You've heard a lot of chatter about the Strait of Hormuz, which is a critical choke point for oil. But it is important to point out that the analysis shows Iran hasn't actually pulled the trigger on a full closure, which would be a massive escalation. All that uncertainty, though, has helped push oil up to $90 a barrel. And look, rising oil prices are never great because they can pour fuel on the inflation fire. That said, the thinking is that because the U.S. produces so much of its own energy, it might not get hit as hard as the rest of the world.
All right, now let's pivot to the much bigger piece of this puzzle. That 75% that's all about the U.S. economic reality. And honestly, the picture here is, well, it's a mess. We just got some data that was a real curveball.
Just look at this. This was the shocker from last Friday. Everyone was expecting the economy to add about 50,000 jobs. What did we get instead? We lost 94,000. That is not just a miss, that is a massive whiff. Nobody saw that coming.
And the takeaway here is pretty blunt. This isn't just a one-off blip. It's a clear signal that the job market is actually weakening. And that matters, because when people lose jobs, they spend less money, and the whole economic engine starts to slow down. This is a huge point for the bears. But then, just as that awful jobs number was sinking in, the market got a huge piece of good news. The Federal Reserve came out and confirmed it's hitting pause. You know, for weeks, the market was terrified of another interest rate hike. Well, that fear is officially off the table for now, and that is a major win for the bulls.
And adding to that good news is where inflation is right now, 2.4%. Now just think about it. We were coming from highs of almost 8%. So for the Fed to rustle it all the way down to here, that's a huge accomplishment and another big check mark in the positive column.
And there's always a but, right? The job isn't done. The Fed's target is 2%. And you've heard the saying, the last mile is the hardest. Well, getting inflation to drop from 2.4% down to that magic 2% number is proving to be a real slog. And the market is watching that struggle like a hawk. Which brings us to this week. And this week is going to be a big one. It's shaping up to be a critical battleground because we've got a flood of economic data coming out. This is where all those bullish and bearish forces we've been talking about are going to collide head on.
Here's the play-by-play. Monday, we get a peek at inflation expectations. Thursday, we get another look at the job market. But the main event, the Super Bowl of the week, is Wednesday's CPI data. That consumer inflation report is the last huge piece of data before the next Fed meeting, and it could totally set the tone.
So let's put it all together now. It really is the perfect image of a tug of war. You have these incredibly powerful arguments on both sides of the rope, pulling the market in totally opposite directions. It's a classic standoff.
This table just lays it out perfectly. On one side, pulling the market up, you've got the Fed's pause locked in, you have inflation way down from its peak, and corporate earnings have been pretty strong. But on the other side, pulling it down, you have those shocking job losses, that crazy high VIX, rising oil prices, and all that geopolitical mess.
So here's where we're at. We have an economy that's definitely showing some serious cracks, especially in the job market. But at the same time, we have a Federal Reserve that has taken its foot off the brake. So the billion-dollar question is this: will this week's critical inflation report finally be the thing that gives one side enough momentum to win this tug of war and tip the scales for good? We're about to find out.